Welcome, everybody. You are attending the Circle of Wealth Impact Investment podcast. My name is Heather Dreves, and I've got my sidekick, Eric.
Good morning, everybody. Glad to be with you.
Yeah, welcome. I know a lot of you that are attending the podcast or even listening to the replay are repeat listeners, so we appreciate your continued support. We're pretty excited about the podcast. I feel like we've gotten quite the following, and we've had some really good feedback from it. So
I think so. We're growing into it.
Yeah, absolutely. I mean, Eric and I aren't going on the road anytime soon, but I think it's been informative. I do want to say that the last podcast we had, and you can replay this at YouTube and Venmo, is that correct? We had a guest speaker from Mountain West IRA, and I don't know about you, Eric, but she was really helpful. I sent a lot of clients to her, and she was wonderful with assisting them on how to roll over their IRAs and also 401ks. So.
Right, and there's this uncertainty and nervousness with going from a traditional IRA to a self-directed IRA, and she has been amazing at just holding customers' hands and walking them through the process.
Yeah, I mean, a lot of the clients that I dealt with had these accounts that had been sitting around for years, and they just didn't know how to even go about getting them moved over so that they can start investing in things like our funds and notes and whatnot, basically alternative investments. So if you have interest in that, let Eric or myself know, just kind of on a side note, and we will get you the replay of that podcast because I thought she was really informative. So good information.
Very good information. Also, we have live chat up and running, so if you'd like, drop a question in there, and we will address those as we go.
Yeah, absolutely. So we're going to get started here. We've got a lot to cover. Fund 3, it's been pretty exciting, has been opened a month now, and we've had some exciting things going on, so we want to share that with you. But first, we're going to give you some updates on the current market, and then we'll go from there.
Okay, let's talk about the market. So S&P 500 year-to-date 19.4, Dow Jones 15.7, NASDAQ 22.5. We've just seen range-bound trading on the equity markets for the past several months. As everyone out there that follows the markets knows, we're trading on news articles and headlines, and we're trading on tweets, right? So a lot of instability in the equities markets. I do feel like we're one negative tweet away from testing those August lows that we saw around the 2850 mark on the S&P 500. So look out for that. I think investors, Heather, are just struggling with the proactive versus static management style, right? Do I raise some cash, take some risk off the table, and rotate my assets, or do I just sit and ride out the business cycle like my financial advisor, who gets paid on assets or percentage of assets, tells me to do? And I hear this from investors almost daily. I'm not sure what to do about my equity portfolio. My financial advisor just tells me to leave it be. But I think there's a much higher likelihood of the market going down than up, which makes sense because the market's up over 300% since March of 2009. Okay, so do we think that the likelihood is higher that it's going to go up or go down in the intermediate long term? So I think it's up to each individual investor, obviously, but it would be prudent to kind of take stock of where we're at from an equity standpoint, and what's best for you, especially dependent on your age, because a 30-year-old investor is obviously a lot different than a 50 or 60-year-old investor. So with that said, the yield curve, we've seen the yield curve widen slightly. The short-term rate, 1.65%, the 10-year, 1.76%. So even though we're not inverted anymore, you're definitely not getting a lot of premium for the extra duration. So, as a country and as a world economy, we continue to be yield starved, and that doesn't look like it's going to change anytime soon, especially with the current federal funds environment and what's going on with those interest rate reductions that we've seen and we'll probably continue to see in the short term. What else? This is interesting. Retail sales posted their first decline in 7 months.
Oh, wow.
That can be paramount only because consumer spending represents 2/3 of the entire economy. So we definitely don't want to see that get too sluggish. I'm not overly concerned, especially coming into the Christmas and Black Friday season. But that's definitely something to keep an eye on, especially if you're heavily overweighted in equities. Let's see. Some good news. The Wells Fargo Housing Market Index rose 3 points, which marks the fourth consecutive advance. So that's good news. With that said, builders are still showing signs of caution with the Chinese tariffs and the possibility of an economic slowdown. So cautiously optimistic from a building standpoint, and I would say real estate in general.
Mm-hmm.
And lastly, the 30-year mortgage rate is at a 3-year low. No surprise there. We're on a declining interest rate environment, and the Fed seems to want to, or at least they're signaling that trend is going to continue. So if you are in the market to buy a home, now would be a great time to lock in a mortgage. And Heather, that's all I got for a market update.
Right. Well, it's interesting. Eric and I both prepare separately for these, and I find it fascinating that when we get together, usually the things that he's going to note and talk about are a lot of the same types of things. I think, you do a really great job at more global overall markets. One of the things that I think I focus a little more closely on is our current market in our area, right, in the Coeur d'Alene and Spokane, Washington market. And, the main reason for that is, as a fund manager, we are buying real estate assets in these areas. And I hear from a lot of clients that I'm talking to about the fund. As some of you may know, 25% of our fund balances can be held in real estate assets. And as always, one of the biggest concerns is what if there's a correction in the market. They just came out with a big article this week in our current newspaper and also on the news that the housing market in the Spokane, Washington market is still hot, especially for homes under $250,000, which sounds probably crazy to some of you in the California markets and whatnot. But we have a huge opportunity as a fund to take advantage of this. That is our target market, is those first-time home buyer homes under $250,000. So we see a huge opportunity here. The other thing that they notated is there's no inventory. Right. Sales have gone down, but it's not because people aren't buying. It's because there's not enough inventory out there. Which is interesting because I had participated in a fund meeting yesterday with our construction crew, and that's one of the things we talked about is now's the time to buy, and especially with winter coming around, so that we can have those houses on the market and ready to go. So we're excited about it. We think that the Spokane market's a great market to be buying real estate assets, as well as Coeur d'Alene. I mean, for those of you folks that aren't familiar with Coeur d'Alene, Idaho, do a little bit of research. It's become very popular for vacation homes. We get a lot of people retiring here. So the housing market, just in this general area where our corporate office has gotten really hot too. So we're excited to venture into that market also.
Very excited.
Yeah. So we want to talk a little bit about the fund. This is the hype right now. Up until now, we did not have an opportunity for people that were non-accredited to go into a fund environment. We are one of the only Reg A funds in the United States that has the model that we do, that mainly sells off our risk with the notes that we originate and selling those off to end lenders, and then participates in real estate assets. So we're super excited about this. I don't know about you, but I've gotten a ton of great positive feedback about Fund 3 and the ability to go in for $1,000. I mean, there's just nothing else out there with that kind of opportunity.
Not only is the fund one of a kind, but I mean, that's the issue right now, is where do you put your money? If assets are overbought, the stock market is a very shaky place to be in the short term for sure. The bond market is brutal. The yields are at all-time lows. So what do you do if you're an investor, just a regular investor that has a 9-to-5 and a family, and you don't have hours upon hours to spend doing research and this and that? Where does the regular investor put their money to have some sort of comfort and get some sort of attractive yield that'll help them achieve their goals? It is very difficult to find that asset class in today's investment sphere, if you will.
Well, and also backed by real estate. I mean,
right.
And you talk about people that have full-time jobs, and, I can attest to this because I tried this, trying to rehab, getting into the real estate and doing things to grow your net worth and, create a legacy for your family is very difficult when you're working full-time. So the fund is a perfect opportunity to go into an environment where you're participating in those real estate assets and those notes.
And you don't have any correlation to the stock market, very little correlation to the bond market. You have true diversification.
Right. So we opened our first fund in 2013. So we've been in the fund industry for a while. In 2014, we opened our second fund, which we called Fund 2, and this was available in addition to the first fund to accredited investors only. So that means you have to have a net worth of $1 million or more, or you can qualify through income standards as an individual or a married couple. So unfortunately, it quickly defined who could go into that fund or those funds. And then the people that weren't accredited, the only opportunity that they had to participate in these type of assets is notes.
I know. And it's one of those things where the wealthy gets wealthier.
Yeah.
Well, obviously, we have nothing against the wealthy, but when you have an investment opportunity that's second to none, but you've got to be wealthy. Your admission is to be wealthy. We don't want to segue or segment the market like that.
Right.
I mean, we want to bring this strategy to everybody.
So August 30th of this year, we were happy and excited and just overwhelmed that we were opening our third fund, the Circle of Wealth Fund 3. We have 12 months to raise $50 million, so there is a 12-month period of time that we can raise capital into this fund. So that is something to be mindful of if you're thinking that this might be a good fit for you. And it is open to non-accredited investors. You do not have to be accredited. Minimum is $1,000 to go into it. Why we opened the fund, it's pretty simple. It allows us to raise money for anyone, not just accredited investors. That's the big one. It offers our clients a financial stake and rewards early adopters for the role they play in the fund's growth. It allows our clients to also, who were once unable to participate in passive returns, to get into the fund environment. And it expands real estate entrepreneurs' access to capital. We continue to fund more deals more often. Kogo's on fire. We just about doubled our staff. So we have loan officers working tirelessly to get all of your brokers' deals funded. So we don't have a concern with deal flow. If you have interest, you can always visit our website at securedinvestmentcorp.com. Once there, you can get more information. You can contact Eric or myself, and we can talk to you a little bit more about the fund. Why we think you should get involved with the fund, and Eric already touched on this. It's non-correlated to the stock market. Right. I don't know how much clearer we can be about that. You have no management responsibility. You don't have tenants calling that their toilet's backed up. You're not trying to rehab a house and you're over the budget and things aren't on the same timeline that you thought they should. The cash flow, our fund does pay out every month. You do have the opportunity or the option to actually roll those dividends back into the fund. Most of the people are doing that I've been speaking with. Its protective equity provides shield against market volatility. There is huge investment diversification. Even if you are a lender that wants to buy a note, let's say you have $50,000. You buy one note, that borrower may or may not make their payments. If they stop making their payments, you are not getting your payments on a monthly basis. When you go into a fund environment, you're diversified. That right. $50,000 could be spread out over 400 notes. There's tax advantage strategies available. We talked a little bit about that. If you have an IRA or a 401k that's not doing anything, you should definitely look into rolling that over to a self-directed custodian that gives you the opportunity to invest in alternative investments. Yeah,
that's a good point, Heather. I actually spoke with a customer this morning. He's been in annuities. He's been sold several annuities by a financial advisor, and he's got an annuity that he's been holding. It's an 8-year-long contract. He's been in it for 6 years, and the account value is less than it was when it started. Yeah, and this is at a time where the market is ripping, real estate's ripping, and this poor guy's stuck in an annuity for 6 years, and it's less than it was initially. So needless to say, he's out of the penalty phase. He's going to be transferring that over to a self-directed IRA and into Fund 3. Nice. So, just look at what you've got. I think half the battle is investors in general don't know what they even own.
Right.
They know they've got investment accounts, and there's something going on in there, and they hope and pray it goes up, but try to do more than that. Take stock of what you've got, see how it's performing, and give us a call if you have any questions, because we'd be more than happy to help you.
Well, I talk to a lot of people that have old 401ks from 5 jobs ago, right. And they have no idea where it's at or what it's doing. Right. So that's a perfect opportunity to take advantage of that, get it rolled over, and get it put it to work. Also, ability to invest in real estate without the hassles of being a landlord. We've already talked about that. Being a landlord, I'm one, is not that glamorous. Neither is rehabbing homes. So let us do the heavy lifting for you. Alignment between the investor and the fund manager. Fund manager does not make money unless investors make money. So we have what's called a preferred rate. It's not a guarantee, but on Fund 3, it is 6%, which means the first 6 goes to the members of the fund. So we are not profitable as a company, as a fund manager, unless we get you at least 6%. And then everything above and beyond that is split 50-50. You also have the ability to keep your IRA funds fully deployed for longer periods of time. This is a common complaint I get, and you would think that investors that fund notes would be happy when their borrowers pay off because they're successful. Most of the time they aren't, especially if they're a paying borrower. The last thing that they want to do is go find somewhere else to put their money, because that money goes back to their IRA custodian. Right. The custodian holds it for a week. Then we have to find them another note or put it in the fund. There's another 10 to 15 days that it's undeployed. So, honestly, it's probably 20 to 30 days that IRA funds are sitting there undeployed when they get paid off on a note. The fund, that money's always out there working. So let's talk about historical returns, because I think that that's something important to point out. Now, I'll precursor this so we keep legal happy, Dan. These are not guarantees. Historical performance does not constitute future performance. But I think it's important to point out, like I said, we've been in the fund industry for a while. This is not our first rodeo. So I'd like to talk a little bit about our historical returns. So in 2014, Fund 2 paid out an annualized yield of 9.24%. 2015 was 11.82. As you can see, we had to get ramped up and get some assets in there, fund some notes, buy some real estate. 2016 was 14.44%. 2017 was 11.06%, and 2018 was 12.26%. So these are the same types of yields that we anticipate Fund 3 has the ability to make. Our target yield right now is 10%. We tried to take a little bit more conservative route. But what I can tell you is Fund 3 is going to participate in the same activities as Fund 2. Right. So again, this is not a guarantee or a promise that that's what Fund 3 can make, just simply a picture of what our other fund has done in its historical returns.
Sure.
So a lot of you are probably saying, well, how does the fund actually produce and create income? So there's several different ways. Income is produced from the sale of properties held by the fund. So these are the types of properties that we're talking about in the Spokane market, Coeur d'Alene market. Once we sell those, all those profits go back into the fund. Points on any notes that they originate, so our COGO notes, Fund 3 will participate in originating those. They earn a yield off of the origination points when we close on those. Interest on notes that are carried by the fund. And then we sell those notes off, and I think Eric does a really good job at explaining the risk that we're selling off, so maybe you can talk a little bit about that.
Yeah, I mean, it's unique, right? Because the average lender is in search for deal flow. They've got access to capital, but they need deal flow. We're the opposite. We have extremely strong deal flow, which allows us to turn our inventory and shed our risk. And what I mean by that is we originate short-term mortgages. We look to sell those mortgages in the secondary market immediately. So we're looking for an interest rate spread, not to hold the loan at duration. So we'll originate at, say, 10%, and we'll sell it in the secondary market at, say, 7%, retaining that 3% spread, and doing that over and over again with our capital. The only reason we're able to do that successfully is because we have extremely strong deal flow. So that is the value proposition from a risk standpoint, right? Because people think, oh, mortgages, if the economy goes bad and people start losing their jobs, they're going to default on their mortgage, and as a fund member, I'm going to be at risk. With this strategy, we try to eliminate that risk component as best we can. The average duration that we will hold a mortgage is 64 days. And the average duration of the mortgages themselves is 18 months. So you can see we're moving them extremely quickly. And yeah, that's how I would explain that.
Our notes sell very quickly. I actually have 2 examples of our first 2 notes, Fund 3 originated, so I'm pretty excited about that. I can tell you that one of them was actually spoken for in regards to an end lender buying before we even closed it. Like, we had to hold him off from wiring his funds. We're like, it hasn't closed yet. So they do turn very quick. We have a very big database of clients institutional and also individual note buyers that buy our notes. So we don't have a lack of people that want to buy notes. Typically, it's more of a inventory issue. So I'll talk a little bit real quick about this. First note that we funded was a property out of Vicksburg, Michigan. This was a refinance transaction. So these people had actually already bought this property, came to us, needed some money to finish the rehab. So they had a lot of skin in the game. So we funded a loan for $82,550. This one turned within like 2 days. Rate of return that we paid our end lender, so the person that bought the note got 10%, and the fund kept 4%. Mm-hmm. So we will continue to get a 4% interest spread on this every month when these people are making their payments. Our servicing department breaks up that payments. The fund gets its interest spread. The end lender gets its note rate. Right. So pretty good opportunity. This property was assessed at or appraised at $127,000. So we had a 65% loan to value. We have huge equity.
Huge.
Yeah. The second one we did was out of Tallahassee, Florida. This was another refinance. This guy had actually already rehabbed this property. It's a great little property, but came to us because he was leveraging it and buying another property. Very sophisticated investor. So we originated a loan for $60,500. We paid an end lender 9%, and we kept an interest spread on this of 2.5%. So 12-month note. This was actually written at a 50% loan to value. So there's a 50% equity play in this note also. So the other thing that we've talked a little bit about is the properties that we buy in the Spokane, Washington market and the Coeur d'Alene, Idaho market. So I thought it might be interesting to see a couple of the projects. I know these aren't ones that we've done on Fund 3 yet, but these are actually 2 specific projects that we bought for Fund 2. We rehabbed them and sold them. So just thought I'd share a little bit of info about that. This was a property out of Spokane that we bought for $135,000. Our list price was $199,000. We sold it actually for $206,000. It got in a bidding war. It was under contract in 5 days of being listed, and we made a profit for the fund of $21,584. So super exciting. I mean, that's a no-brainer. I think this thing, by the time we bought it and turned it, was in under 90 days. That's huge profit for the fund. The other one I was going to show you was a property also out of Spokane. Sell price was $179,900. I can't even talk today. $179,900. We sold it for $185,550. So this is another one that also went above and beyond what we listed it for. And we had a profit of $21,501. Nice. So another big win for the fund. So we love those. Those things really juice the yields of the fund. Our fund reports actually break out interest earned, profits from properties. And whenever we have big quarters with properties, you know, and we sell 4 to 5, we have huge returns. So it's easy to see that this is a good strategy for both of the funds. So do we have any chats in?
I think before we get into that, I think here, let me give this to you here. I think one thing that we don't talk about enough is the investment committee. You know, and our CEO, Lee Arnold, is the chief investment officer and has about 20 years experience in flipping real estate, has done over $1 billion in transactions, and is a huge, huge part of our success here. And I don't feel like we talk about him and the role he plays enough. Mm-hmm. Because he is a secret sauce. And the reason why we do our real estate transactions here locally in the Spokane and North Idaho market is because he's the master of this area. I mean, no one has a better pulse over the real estate market in Eastern Washington than he does. And then I also say my partner here is probably one of the most knowledgeable people in the industry when it comes to private lending, notes, and that side of the business. So we're extremely well equipped from a manpower standpoint And I just don't think we really give ourselves or give you enough credit in that regard.
That's nice of you. Thank you. I will tell you, it takes a team of us. I mean, one of the things that I think sets us aside also with our funds is we're very organic. Like, we are not relying on buying leads to originate notes from other people. We have our own origination department. A lot of our clients, whether they're brokers or borrowers, come from our education. That feeds into that deal flow. One of the things that we did when we first started the funds and we were buying real estate, we were trying to sub out all the work.
Right.
And we found it just was impossible. I mean, the timelines and the quality of the work. And this is a huge testament to Lee. He said, forget this. We're going to build our own construction crew. He got our contractor's license, and we have our own team. So we don't rely on subs to get these projects done. We meet on a weekly basis on all of those projects as a team. I was in the meeting yesterday. There were like 12 of us in the room. It was crazy. We have an amazing accounting department. And without Eric raising money for the funds, I have Lisa in my office selling the notes. So it takes a tribe, but I do think that we have a rock star team, and we have it down to a science. It's a well-oiled machine. And is it always perfect? Do we always buy the best the properties? Does a note not ever pay? Absolutely. I mean, those things happen. But I think because we have such a close pulse on it and we meet so often as a team, we can strategize and pivot very quickly to, change strategies, identify problems, or identify activities that we think are going to be more profitable. So I appreciate that. Thank you.
Call us.
Yeah, absolutely. So I put our contact information up on the PowerPoint, so you should be able to see that. You can visit circleofwealthfund.com. The funding department's number is 800-898-2717. Eric and I are here all day, all the time, so you can reach either of us. It looks like there were a couple questions. Tafari, thank you. We appreciate you also. It looks like maybe some of you had a little disconnect. The feed was not great, and then it came back on, so I hope you're still able to see us and hear us. But Rick had a good question. He asked what the minimum tie-up is for the fund.
The minimum tie-up is 12 months. So we're in for 12 months. After the 12-month mark, you can divest up to 25% of the account value per quarter thereafter.
Great.
Thanks for the question, Rick.
That's a really good question. Not to beat a dead horse, but the minimum to go in is $1,000, and it has to be in $1,000 increments. So you can't put $1,500 or $2,500. It would have to be $1,000, $2,000, and so forth. We can help you if you have IRAs. If you need any of that help, please let Eric or I know. We've got a great resource that will help you if you need to roll it over. If you already have them set up with self-directed custodians, we can also walk you through that process. There's some forms that they typically require you to fill out. But we'd love to have you be part of the fund. I mean, it's as simple as that. We think this is a huge opportunity to get involved, not just with the fund, but with the company. I mean, you are helping our borrowers accomplish their goals and dreams, our brokers, people that come through our education that are trying to get started as, a real estate investor.
Right.
So it's a pretty exciting time to get involved with it.
I totally agree.
Yeah. So again, if you want to get a hold of Eric or I, call our office at 800-898-2717, or you can visit our website at circleofwealthfund.com, and you can request more information from there.
Absolutely. Bye, guys. Thanks for joining us.
Thank you.
Have a good day.